Good evening, everyone. Thank you for joining in. I'll be hosting today's MarketSmith India webinar for you. My name is Jyotak Nandwana, and today's webinar topic is Understanding Portfolio Construction. Just want to check in the meantime whether the voice is audible to you guys. You can reply in the chat box. Okay, great. So you guys can hear my voice, and right. So today's topic is understanding portfolio construction. And before we begin the webinar, I would like you guys to spend few seconds in reading the disclaimer. So basically, stocks that we discuss in today's webinar, they shouldn't be considered as a recommendation to buy or sell a security. And all information that is provided here is for educational purpose and in no way should be considered as investment advice. Right, so this is going to be our agenda today. Before we dwell into the main topic, that is understanding portfolio construction, we'll be having a quick discussion about the current market environment, how the Indian market is shaping up. Then we'll move to portfolio construction. So most of the investors, they spend a lot of time on stock selection. They have an obsession with stock selection, but our experience suggests that stock selection is just one component of successful investing. The other one is portfolio construction. So if your stock selection is great, but you don't pay much attention to portfolio construction, you might not get the desired results. Stock selection, of course, it becomes easy once you have an investing strategy with you. So for us, like we follow the CAN-SLIM investment strategy, selecting stocks won't be much difficult because we have a lot of fundamental and technical criteria already set in, and that throws up a good list of stocks. So I'll just briefly give you an overview. Under CAN-SLIM, we'll be looking for stocks with massive sales and earnings growth, stocks that have high return on equity. There's something new which is happening in the company. It could be a new product or service, new management, new industry trend, or even a new government regulation that could provide a tailwind to the company. There is high accumulation that's going on in the stock. That is, there's a lot of demand for the stock. And it's a leading stock, that is, it has a high relative strength. It could be a leader in its market as well, with leading market share. And it is in top industry group also. Besides, there should be presence of institutional investors, and the market condition, overall market conditions should be favorable. Right, so that's the overview of CAN-SLIM. So once you have selected stock, the next thing is how to approach portfolio construction. Now, it wouldn't be fair for me to tell you what exactly to do, because as investors, we all have our own risk tolerance and our own way of doing things. Having said that, we all should be under the CAN-SLIM shell, and we should use the methodology to screen stocks as our basis, and then we can find out what works best for us individually, because we all have our own ways of going about our business. Then we'll be discussing about the common mistakes that new investors make with portfolio construction. Also, the stocks that we look at, is it a model stock or is it just another stock that is moving up? So that will be the next section. And the final one is the force feeding method for weighting your portfolio. Now, this is how our founder William O'Neill was able to generate superior returns for multiple decades in the stock market. He did that by concentrating his portfolio in a very methodical manner, and we'll be going over that in the final section of today's webinar. Right, so if in case you're not able to hear me, while most of the participants, they can hear me, few are saying that they are not able to hear me, I would request you to rejoin the meeting or check your settings once, because there seems to be, everything seems to be fine over here. All right, so let's move on to the next slide, which is the current market environment. Right. So this is the daily chart of our key index, that is Nifty 50. As you can see, the current market condition is under pressure. The distribution count has gone high to 5 on Nifty, and 6 on Sensex. Now this is a high distribution count, considering the market had been doing quite well over the past year, and if you can see, it had hit an all-time high during the month of January, around mid-January or so, and then there has been a sell-off in the Indian market. Now, the India's key indices, they have breached the 50-day moving average also, and they are around 7.5% below their all-time high. So Nifty 50 is around 7.3%, Sensex is 7.5%. The sell-off in the mid-cap and small-cap stocks has been more intense, and mid-cap and small-cap stocks have corrected hugely. So Nifty mid-cap is down almost 11% from its all-time high, while small-cap index is down around 15%. So this gives an idea about the current market environment. Doesn't seem to be too great for investors to be investing right now, because the overall market seems to be under pressure. And also, if you see that the index, they made a low of they made a previous low around levels of 10,276, the Nifty, and that was made on 6th February. And with today's fall, it has come very close to that level again, around just about 0.8% higher from that level. And if we see that it goes beyond that level, it falls below that level, and the distribution count, as we can see, is already high, we might be forced to move the Indian market into a downtrend. Now, considering this market condition, we all thought that talking about portfolio construction would be a very relevant topic, because when markets don't do well, most of our stocks obviously will not do well, because 3 out of 4 stocks, they follow the general market trend. And when our portfolio doesn't do well, we might be forced to book profits or even cut losses in stocks going by Cancelim investment methodology. Now when we do that, there might not be many stocks in our portfolio. Now look at the example of our own model portfolio. We had around 33 names in January, and that has come down to just 8 now. So this is a very good time to hone your portfolio construction skills, know a lot about how to construct an ideal portfolio, and that's why we thought that we should be doing this webinar in this series. Right, so that was about the current market. Now next we move on to what is portfolio construction. Okay, so I have a query. Right, Rajesh is asking how many distribution days are required to declare a downtrend. Rajesh, normally we look at distribution days of around 5 to 6. If the distribution count is around 5 to 6, the index is it should be in a downtrend. But then we also look at other indicators, like how far it is from its 50-day moving average, how far it has fallen from its all-time high. Is it finding any support near the previous lows? And that's the case for the Indian market right now. And that's why we have kept it under pressure for now. But if we see further weakness, more likely we could see the Indian market going into a downtrend, because the distribution count is already high at 5 on Nifty and 6 on Sensex. Right. So if there is any query which might not be very relevant to the current topic of discussion, that can be asked during the end of the session. We are going to have a dedicated Q&A session towards the end of the webinar, and I would request you to save all your queries for that time. And if it's quite relevant to the current topic of discussion, I would be happy to answer them right away. Sanjay, all those 8 stocks which you have asked in our portfolio, that can be seen under model portfolio in the MarketSmith India app. Right, so moving on, so what is portfolio construction? Now, portfolio construction is how we compose our portfolio, right, on the basis of beta, volatility, market cap, industry group, and liquidity. So there are separate characteristics that can be looked at. Beta and volatility, they fall in the same realm. Our aim should be to construct a portfolio that minimizes drawdowns and optimizes return. Right? However, investing, it's a game of ups and downs. All investors, even great investors, they go through drawdown periods, and we must learn to deal with these, right? Like the current one is being a drawdown period. We have seen key indices falling over 7%, while mid cap, small cap, they have fallen over 10%. So it's a drawdown period, and if we have very high beta names in our portfolio, we could see our portfolio going down by 20-30% easily. right? So don't get disheartened if that's happening. All we need to do is to construct a portfolio such that, as I said, it minimizes drawdowns and it optimizes returns. We need to strike a balance because sometimes when we have greater returns, it is also likely that we are having a greater risk. So having a proper portfolio construction, it will help smoothen the equity curve. So equity curve is basically the portfolio value over a period of time, and there's not a lot of wild swings if you have constructed your portfolio properly, and it kind of moves in a very normal linear line. I wouldn't say linear, there will be a little bit of volatility, but it's quite less, and that's what we need to do. We need to have less volatility and maximize gains using that. Like I said before, most people, they want to focus on stock selection. Stock selection is important, but it often leads new investors to overlook portfolio construction. So once you have got a good stock, say the market was doing well, you added quite a few stocks to your portfolio, all were good stocks, all were meeting canceling criteria, but those were high beta stocks. Now what would have happened to them when the market started pulling back? Those would have corrected a lot. We'll be showing those examples to you in coming slides, and that will hurt your portfolio a lot. So in my opinion, portfolio construction is just as important as stock selection, if not more important. Right, so this is how we would have thought about stock markets when we were beginning our investing journey. And stock market would have seemed like a roller coaster ride for most of us. And it is actually like that because we never know what's going to happen next. We don't know what's going to happen tomorrow, next month, or even the next year. So as investors, all we can do is to manage our risk. Now, there are ways to put the risk-reward ratio in our favor and smooth out that risk over a period of time so it can be less emotionally draining and less stressful for all of us as investors. So that's how we need to manage volatility, and so that it could be leads to less stress for all of us as investors. Right, so the first question that you need to ask yourself is, what is the volatility in your portfolio? Now, how do you measure that? So we have one measure which is known as beta. It measures the stock price's volatility relative to price performance of a key index such as Sensex over a 12-month period. Now, high beta stock means it will have greater price movement relative to the market, while low beta means it will have smaller price moves in relation to the market. High beta stocks, they tend to have wider price movements, and they're usually very good to have when the markets are doing well, and they're equally tormenting on the downside. Now, there is a beta measure which is available in the MarketSmith India application. You can go to a stock, and under the details tab, you can check for the stock's beta. Apart from that, I also like to use the daily chart that gives me an idea about the stock's volatility. So if a stock is moving in a stair-step kind of a scenario where it keeps moving steadily up and doesn't face a lot of wild swings, the stock shouldn't be having a higher beta. While if there is a lot of wide and loose price swings, it means the stock is having a high beta. Right, so Sanjay is asking what's its range and what is standard value. See, Sanjay, a beta of 1 indicates that the stock is moves in line with the market. A beta higher than 1 would mean that a stock is a bit risky. So I wouldn't say that a beta of 1.1 would be risky, but if it moves more towards 1.5, 2, 3, that is a very risky stock, while stocks that have beta less than 1 tend to be less risky. Yes, Shubham, beta is there in our application. You can check it under the details tab. Even towards the end of the webinar, I'll try to show it on the app as well. Right. So one thing to notice or to observe over here is, do not get confused between relative strength and beta. Both are different. Beta shows how much does a stock move, right? It could be both on the upside or downside, while relative strength shows whether the stock is moving in the right direction. So if a stock has a relative strength ranking of say 90, it indicates that it outperforms 90% of the stock of all other stocks and is doing quite well. However, if a stock has a beta of say 2, it could mean either way, that when the market is up, the stock could move. When the market is up 1%, the stock could move up by 2%, whereas when the market is down by 1%, the stock could go down by 2%. Right? So an ideal situation would be to have stocks that have low beta and have high relative strength. So this is a very rare combination, because stocks that tend to do well could end up having high beta, but you might be able to find a stock where the beta is quite low. It could be around 1 or even less than 1, and the relative strength is on the higher side. Okay, Roshan, I would request you to rejoin if you're facing any issue with audio. Right, so that's the ideal situation when we can find low beta stocks that have high relative strength. Now next, moving on. This is an example of a steady mover, right? So this is 3M India, and it's a low beta stock. Its beta is around 1, and its relative strength, as you can see, its RS line is touching new highs, and it has a relative strength ranking of 83. Okay, just want to check with everyone if you guys are facing any audio issue. Are you able to hear me clearly? Okay, okay. Give me a moment. Let me check if yeah. So few participants, they are seeing there's some issue. Give me a minute to just check. Yeah. Okay. Can you hear me now? Okay. Okay. Great. I'm sorry about that. There was some issue with the network. Right. So as we were discussing, we were looking at the chart of 3M India. As you can see, 3M India has been a very steady performer. It has given quite great returns in the past as well. And you can see that the stock tends to move in. This is a weekly chart, so you can see a little bit of price swings over here. But even then, you can see that the stock kind of keeps close to its 50-day moving average. There was a bit of consolidation over here. In the current market as well, you can see that there was a tight area formed here. Then the stock kind of moved slowly and steadily towards its new high. And also in the recent sell-off, the stock has not done that badly. It has kind of held on to its gains. It is quite close to its 52-week high and is doing quite well. So this is an example, very good example of a low beta and a high relative strength ranked stock. So as investors, our aim should be to to find these kind of stocks, because these kind of stocks, they will help us a lot whenever the market pulls back and there's a sell-off in the market. These kind of stocks, they tend to stay sideways, and they do quite well whenever there is a sell-off in the market. Right. So that was 3M India. Now next we move on to an example of a volatile stock. So this is a high RS stock, but this is also a high beta stock as well. So this is Phillips Carbon Black. Phillips Carbon Black. Now, if you can see that this is a daily chart of the stock, you can see that there are quite a lot, wide price swings. You can see that the stock kind of moves up 10-15% easily. Then there are gap downs as well. There are gap ups over here, and there's a gap down over here as well. So you can see that this kind of stocks, it fluctuates a lot, and that's the reason why it is a high beta stock. Now, if you look at how the stock has done in the recent sell-off in the Indian market, you can see that while it broke out of a consolidation-based pattern, it did well initially, but then as the overall market began to weaken, the stock came crashing down, and it corrected almost 40%. So around the levels of 1600, it made a new high around 1600, 1594 to be exact. It came crashing down to 942. So that's a correction of a good correction of 40%. And such stocks will, it will dent our portfolio returns quite a bit. They are good to have on the upside, but when the market enters into a downtrend, such stocks will face a lot of correction. However, having said that, the stock has done well to reclaim its 50-day moving average, and that is a good sign over here. So that was an example of a volatile stock, yet a strong performer. Right. So next we have is character of the stock. So how do you judge whether your stock is a very volatile one? Is it does it tend to be a gappy stock? You could see a lot of gap ups and gap downs. So gap up and gap down, if some of you are not aware, it happens when a stock opens at a higher price compared to the previous day's close, and same thing is on the downside as well. So does it tend to be too gappy, or is it a grinder type of a stock? A grinder type of a stock would be the example of 3M India, which slowly and steadily does its job, keeps moving up, and whenever there is a market correction, does it tend to fall a lot. Since we are discussing about stocks, I would like to reiterate that these are only for educational purpose. Do not consider them as investment advice, because I see few queries coming in whether they should buy these stocks or not. Right. So is your stock a grinder type, or is it a high beta hacksaw type that sees a lot of wide and loose price swings? Now, if it is a grinder type, all you have to do is build a large position size with smaller risk. So you can tend to have a stop loss rule, not necessarily around 8%, but can also have a stop loss rule around 5 to 6%, because these stocks don't face that kind of price swings as compared to the volatile ones. However, if it is a hacksaw type, you must lower your position size, that is not have much exposure to that stock in your portfolio, and widen risk. So you need to have stop loss around 8%, maybe even around 8 to 10%, so that you can handle the added volatility. Right. So Shubham is asking, what do you mean by large position size? So large position size, I will come to that in a bit. We'll talk about how one should only have concentrated portfolios of around 5 to 10 stocks, not more than that. So I'll be coming to that. And when it comes to large position size, so as an investor, what you can do is maybe you can have an equal allocation to all of your stocks. So if you have 5 stocks in your portfolio, you can allocate 20% to each stock. But if it is a high beta, hacksaw type of a stock, I would suggest you shouldn't have an allocation of 20%. You should keep your allocation around 10-15%, or maybe even less than that, especially in a market which has run up a lot and is in for some trouble, like the Indian market currently. So at this point of time, I would say a lot of your stocks should be the grinder type of stocks, low beta kind of stocks. However, when the market begins a new uptrend, that might be a good time to get your focus back to the hacksaw type of stocks. All in all, the stock selection process should remain the same. It should have canceling characteristics, and it's just that when it comes to portfolio construction, we tend to look at the character of the stock. Right. So Also keep in mind that everything should be considered in the context of your portfolio. You cannot expect to have all high beta stocks and a smooth equity curve, because if you have a lot of high beta stocks in your portfolio, in fact all of them as high beta stocks in your portfolio, you'll see a lot of price swings. On the other hand, you cannot expect to have optimal performance with all low beta stocks, because at the end of the day, if you want to get performance, you need to have few high beta stocks in your portfolio. Right, so there's one question from Raj Panda regarding can we hold the Haxo type of stock for long term, at least 1 year. See, Raj, the long term definition or the short term or the medium term definition, it differs for each kind of investor. What I have noticed is investors who enter into market thinking that they'll earn short term profits, they end up becoming long term investors because those stocks have fallen below their purchase price. So I wouldn't, for me, there is no definition as to long term, medium term, or short term. I would like to focus on the price performance of the stock. If even though if it is a Haxo kind of a stock, if it tends to do well, if it is keeping above its 50-day moving average, it does well in market correction, doesn't pull back much, and it is not showing signs of weakness, I would continue to hold it. Right, so Shubham is asking what should be the ideal ratio of high beta to low beta stock. Shubham, as I had said in the earlier part of the webinar, it would be unfair for me to give you a clear-cut strategy, because what happens is, as investors, we all have our own risk tolerance, we all have our own method of facing risk. So if you're a kind of a investor who likes to take additional risk for additional returns, maybe you can have a little bit more concentration towards high beta stocks. All I would like to say over here is, when you see that the market has run up a lot, it has given good performance like the Indian market has done in the past 1 year, it's better to be a little cautious when you see signs of weakness, and that is the time when you should cut down your exposure to high beta stocks and maybe increase exposure to low beta stocks. Right, so Binish is asking what is the stop loss strategy for Haxo type of stocks. Stop loss strategy remains the same, Binish. The only thing that I had said over here is, for stocks that are grinder type of stocks, like they don't see a lot of price swings, maybe you can keep your stop loss level a little lower than 8%. But even then, an average stop loss of 8% is the ideal way to follow, because William O'Neill in his research found out that when bought at the ideal buy price, greatest winners rarely fell over 8% from their pivot price. So it is ideal to keep around the stop loss around 8%. But for the gappy kind of a stock, I'm sorry, for the Haxo kind of a stock, you might have a stop loss around 8 to 10% might be fine. But as I have said before, stop loss is crucial. You don't want to be stuck in a stock that is down, say 30-40% from your buy price. Right. So the final point on this slide is, there are no black and white answers, but we need to think about all these factors when we are constructing our portfolio. All right. So it's a balancing act, right? As the picture suggests, we don't need to come up with crazy formulas to assign weights to stocks. All we need to do is to think from an overall portfolio perspective. So how your stocks, let's say how your stocks, you should ask yourself how your stocks will react to, say, a 5% pullback in market. Because 3 out of 4 stocks, they follow the general market direction, and high beta stocks in such cases could fall 10 to 20% easily. So whenever there's a pullback in the market, high beta stocks, they tend to fall a lot, like we saw in the case of Philips Carbon Black. The mid cap index and small cap index, while they have fallen around 10%, Philips Carbon Black came down crashing hard with a correction of 40%. So that's a huge correction, and we should make sure that we kind of get out of such stocks whenever we see weakness in the market. Right. So Kiran is asking how to know where to book profit. So Kiran, we have done a similar webinar before. You can find that recording on our blog as well. So ideally, profit booking level is around 20-25% from the ideal buy point. The reason is stocks tend to consolidate after breaking out of a base pattern. They rise 20-25% and then they consolidate after rising 20-25%. So that's an ideal profit booking zone. But in case if the stock is showing signs of strength, if it continues to make new highs, you might want to hold on to it a longer. There are exceptions to that rule as well. You can find that in our in the previous webinar that we had done on booking profits, right? So again, coming back to the balancing act, we need to balance our portfolio with a set of both high beta and low beta stocks. Ideally, if we are able to find stocks that have low beta but high relative strength, that is the place to be. We should be looking at those stocks, especially when the market is showing signs of trouble. Right. Next, we move on to diversifying. So this is another important aspect when it comes to portfolio construction. We need to diversify on the basis of industry group, sector, market cap. So there's no point in having all stocks from the same industry group, or maybe from the same sector, or even from the same type of market capitalization. Like if you had your portfolio exposed to all small cap stocks, your portfolio would have taken a lot of beating in recent times. So never have more than 2 stocks in the same industry group. Like I have said, we need to have a concentrated portfolio. We'll come to that in a bit. But in a concentrated portfolio, say of 5 to 10 stocks, make sure you don't have more than 2 stocks in the same industry group. Usually an industry group will have 2 distinct leaders, and it is not ideal to have exposure to more than 2 stocks in the same industry group. So you need to spread your exposure across industry groups and sectors as well as market cap. Pay close attention to sector weighting. That's because as Cancelim investors, what can happen is we might get overweight on high growth sectors, but we do not want to be in just 1 or 2 sectors. We need to be able to survive pullbacks and not act on emotion. So if you see a lot of stocks that are breaking out from a same industry group, that can happen when the market is doing well. There will be few sectors that will be leading the market rally. If you see a lot of stocks breaking out from that sector, make sure that you're present in the best, say 1 or 2 leaders of that particular sector. Again, everything is in the context of your portfolio. You shouldn't be thinking only from the perspective of one particular stock. You should be thinking from the angle of how all stocks make up your portfolio, and that's how the risk should be assessed, right? So that's about diversifying. Next we have is liquidity. Now this is another important aspect that one needs to consider while building a portfolio. Make sure that you're not looking at illiquid names, because there's no point chasing illiquid and penny stocks, as they will receive a thrashing whenever markets correct, right? And one more thing is that institutions are the ones that dictate the price action in leading growth stocks, and larger funds, they like to look for growth and liquidity. So it's a very rare combination. Stocks that are growing at double-digit growth rates, sales and earnings are growing at a fast pace, and they're also liquid in the market. So there's a lot of trading volume in the market. Larger funds, they like to look at such stocks, and since larger funds, they don't normally look at penny stocks, it wouldn't pay off to get into penny stocks. So if you think that if a stock is priced at 5 rupees or 6 rupees, there's a reason why it is priced at that level, and there's no point in chasing such stocks. However, if you come across a very good quality illiquid stock, keep your position size smaller. So this is very similar to the Haxo type of stock. If you see that all else equal, like all other factors are looking good for the stock is good in terms of fundamentals, but the liquidity is not great, make sure that your position size is not too large in that particular stock, in a sense that not a lot of your portfolio amount is going in that illiquid stock, Right. So what there's a query from Shubham. What exactly makes a stock illiquid? Right. So Shubham, what happens is at MarketSmith India, we look at the average daily trading volume for the past 50 sessions, and we have set a criteria of around 60-70 lakhs. So average trading volume should be at least 60-70 lakh rupees. However, it would be good if you look at stocks that have an average trading volume of at least 1 crore rupees. So you can see that in our application in using filters. You can check the average rupee volume of a particular stock. Also in the checklist tab. So if we have time towards the end of the session, I'll try to show that. Else you can see our videos on the MarketSmith India features, and you'll be able to find that. Right. So as I said, make sure your position size is smaller if you come across a good quality illiquid stock. Now, the reason is when the stocks that have good amount of liquidity, that such that their trading volumes are high, they are more likely to be supported whenever there is a bad news in the market. That's because such stocks are held by institutions, and you would normally see that whenever there is panic in the market, institutions they hold on to their positions tightly. Right. Also, you need to weigh your portfolio toward mid and large cap stocks. Small cap stocks, they tend to be a little risky. So make sure that your portfolio is dominated by mid and large cap stocks, especially when the market is showing signs of trouble. Okay, Chandra, I would request you to send stock-specific queries to using the Ask MarketSmith feature, or maybe we can look at them towards the end of the webinar, right? All right, so let's move on. So that was about liquidity. Now, next is once you have identified a set of stocks, now you need to look at whether that stock has characteristics of a model stock. Does it look like a big winner, or is it just like any other stock that is moving up? So we need to be snipers in our stock selection process. We need to be very picky with portfolio construction. Now, a model stock would have characteristics of a CAN-SLIM quality stock. So, does it have high sales and earnings growth? Does it have higher return on equity? So, if it meets all those criteria, it is possible that the stock could turn out to be a big winner in the coming time, right? So you need to be you shouldn't be chasing all the stocks that are just going up without any backing of fundamentals. So you need to ask yourself whether a stock, is this a stock that I'll be able to hold during a pullback? Now for that, you need to know a little bit about the company. And that's the reason why whenever we add a stock to our portfolio, we send a detailed addition report to our users, because that will give them an idea about the company. Apart from that, you can also spend some time on doing some additional research, understanding the business model of the company, and how does it generate revenues, what are its products and services. So that will help you in developing a bit of conviction in the stock. And whenever there is a downturn in the market, you will be confident about holding it for some more time, right? And you should also ask a same question from the context of your overall portfolio. So if it is a highly illiquid stock or the Haxo kind of a stock, that will dent your portfolio returns whenever the market enters into a downtrend, right? So overall, all in all, if we are in liquid leaders, that is highly liquid stocks with high earnings and sales growth, we are most likely to be bailed out whenever there is an issue in the market. Right, so that was about that. Next we have is the force feeding method. So this was the method that I had talked about in the beginning of the webinar. So what do you mean by force feeding? So basically what we need to do over here is have a set of stocks in our portfolio and feed our winners and cut our losers. So basically whenever you build a portfolio of say 5 to 10 stocks, the stocks that tend to do well will give you add-on areas, and you need to add to them instead of uh, buying stocks that are not doing well for you. So as Cancelim investors, our goal is to have a concentrated portfolio of 5 to 10 growth stocks. Now this again depends on your overall portfolio size. So if you have a portfolio of say 5 lakh rupees, maybe a number of 5 would be good for you. Around 5 stocks would be good. Whereas if you have a portfolio of around 10-15 lakhs, then maybe you can have around 10 growth stocks. The idea over here is you shouldn't be having more than 10 growth stocks, is that in the end it will dilute your returns, and if you really want to have a lot of stocks, then it might be better to hold an index fund. Right. So pyramiding, I was coming to that. How do we force feed? We do that by pyramiding into our stocks. Pyramiding is basically averaging up, and this is the strategy that William O'Neill has been a big proponent of. So if a stock has done well for you, and say it has given a 20-25% return, and if it breaks out again, maybe you can add more to it, and that will help you in increasing your exposure to winners while cutting your exposure to losers. So suppose stocks that are not doing well, you can take some money out of that and you can force feed your winners. Now you need to not add stocks just because they have gone up 20-25%. You need to look for add-on areas. These are available in our application. You can see whether a stock has broken out recently or not. Also look at tight areas. So if a stock has been making a tight area of say 3 weeks or 5 weeks, it was trading in a very close range and suddenly then breaks out from that area, it could provide as a good add-on area. Also, rebound from 50-day moving average is a very good opportunity to add to a good quality stock. So normally good quality stocks, they will find support at 50-day moving average, and if you see a stock that rebounds from the 50-day line, it might present you a good opportunity to add more to it. So you shouldn't be adding arbitrarily. You should be a robot and you should follow a clear set of rules when adding to your existing positions. That's because when you're adding to your portfolio, you're also adding risk to your overall portfolio, and you need to take the long view, that is keep the long-term picture in mind, and make sure that you're not overexposed to high beta names and underexposed to low beta names that could pay off well when the markets are doing really well. Its market is in an early stage of an uptrend, but the same strategy would hurt you a lot when the market begins to correct. Remember that investing is a marathon and not a sprint. You might not be able to generate a good amount of return, say in a 1 or 2 month period, but suddenly if you see suddenly in the next few months your existing stocks could do well, and they could give you decent returns. So all in all, we should be disciplined and we should follow these rules so that our emotions are kept in check. All right, so that was force feeding and a little bit on the concentrated portfolio. Right, so that's it for today's webinar. It's time for the Q&A session, and I would request you to send in your queries on the chat box. Okay, so there were a few queries that I had received previously. I kind of missed them. I'll just have a look at them as well. Right, so Sanjay is asking, what's the role of shareholding pattern in stock selection and how MarketSmith measures its count? So Sanjay, obviously, if you see a stock that has a high shareholder, share, so for shareholding pattern, what we look at is the presence of institutional funds. So if you see a stock that has a high number of funds present in it, that gives a little bit more confidence, and we normally look at stocks that have at least some bit of institutional sponsorship and there is presence of institutional funds. Okay. Right. So Saroja is asking that I have zero stock now in my portfolio. How should I start considering nothing is added? Right. So this is the current market. It's not giving a lot of investment opportunities as of now. We do not see a lot of stocks that are breaking out of base pattern. In fact, in today's session, there were nil breakouts, no breakouts, and the number of stocks hitting new highs are also quite low. So it's a very weak market, and for now, it's better to kind of wait for the market to stabilize and maybe begin a new uptrend before getting into it, because there's a good chance that the market might go further down, looking at the high distribution count. So if it's not able to get support at its previous low, we could see the market entering a downtrend. Right. So, Naveen, there were few stocks that might not be meeting 100% of cancellation. That can happen. We will come across exceptions where we will be looking at most of the criteria that's being met, and it might not be 100% cancelling stock. But we need to understand that cancelling has a subjective factor of n, and there could be something new which is happening in the company, and while its fundamentals uh, might not be great over a 3-4 quarter period, but it might have improved in the recent quarter, and that could be the reason why a particular stock might be added to a model portfolio. But then the overall weakness in the market has played a larger role in seeing a few removals from our portfolio. So when the market goes under pressure, you'll see the mid cap and small cap stocks doing fairly badly, and that's when you might have seen few removals from our portfolio. But all in all, we need to also understand that it's a risk management tool that we have. The stock that is being removed, while there might not be a change in the fundamental characteristics of the company, we need to make sure that we are getting out of it and following a rule, and not taking decisions based on our emotions. An 8% loss is always better than a 20-30% loss. And even if a stock, say it goes to declines by 20% and comes back again, it could be in for a long consolidation. So it's always better to take out your capital from it and maybe deploy it to a better investment opportunity. Yes, Sanjay, if promoter holding is less in any particular stock, that needs to be looked at again. However, if you see that the institutional sponsorship continues to grow in the stock, that will give you an added confidence, considering the stock meets all other fundamental criteria. Right. So Vikas is asking, if we have money around 2 to 5 lakhs, how many stocks should we buy? What will be the ratio for large cap, mid cap, small cap? Again, there is no clear cut rule as to how much of your money should be in large cap, mid cap, small cap. All you need to do is, based on your own risk tolerance, you need to identify if you are able to take additional risk. Maybe you can have a more exposure towards small cap stocks. If you are a bit risk averse, then maybe a more exposure should be built on large cap stocks. So with a portfolio size of around 2 to 5 lakhs, as I had said, around 5 lakhs, you can have exposure to around 5 to 6 stocks. Right. So, Mitesh, it would be difficult to talk from the perspective of MarketSmith India model portfolio. The model portfolio will have a lot of names, because besides trying to beat the index, we also want to make sure that our users are getting investment ideas regularly. There could be users who join us, who have joined us recently, and therefore we need to make sure that those users are also getting investment ideas. So in our model portfolio, we might not certainly go for the beta and relative strength kind of a thing. But what happens is, whenever we see that a market is kind of correcting and is looking weak, then we'll certainly look at the kind of stocks that we need to keep. So for now, like, we have few names that are showing high relative strength and have low beta. So that's what we do when we see weakness in the market. Okay, so Sudhir is asking, how often do we add stocks to portfolios? Sudhir, it depends a lot on the overall market. M, which stands for market direction, in CanSlim is the most important factor that needs to be looked at. If the overall market is doing well, we might add 3 to 4 stocks in a month, even more than that. But say if the overall market is not doing well and we do not see a lot of good quality stocks that are breaking out of sound chart patterns, we might not add any stock to our portfolio. Right. So for stock specific queries, it will be more easy for us to answer if you send it across through Ask MarketSmith. For now, I'll be looking at the general queries, which has more to do with today's webinar. Okay, so a brief explanation is required on grinding and hacksaw pattern. So as I had mentioned, Srinivas, I had given a couple of names as well. So 3M India was a very good example of a grinding stock, keeps moving up in a steady manner, doesn't face a lot of drawdown when market corrects. On the other hand, hacksaw pattern will face a lot of drawdown when the market will correct, and has a lot of wide and loose price swings. Right. So Naveen, when you want to keep 5 to 6 stocks, so that is what is our aim at MarketSmith India. We just do not focus at only giving stock ideas. We also want investors to improve themselves and understand the CanSlim investment methodology, learn the nuances, and that's the reason why we have the bi-weekly webinars and regular CanSlim seminars. So what you can do is, if you see that there are a lot of stocks in the model portfolio, you need to evaluate. And that's where the evaluation section will help you. How does it score on earning strength, price strength, accumulation distribution rating, whether you like the business model of the company. That could be a personal preference. And so model portfolio stocks, even if we have a lot of names, most of them will meet the CanSlim criteria, but on an individual stock basis, you can certainly evaluate them on how they score off from the rankings, and that's how you can select the top 5-6 stocks in your portfolio. So suppose if you have, if we have given you 5-6 names, you have added all those names in your portfolio, and then you see a new stock that is getting added to our portfolio. What you need to do is look at your portfolio again, go back to your portfolio, see which stock has done well for you, keep that, see which stock is showing signs of weakness, hasn't done well, is moving sideways, is approaching your stop loss, or maybe breaching the 50-day line. Maybe you should come out of such weak stocks and then invest that money into the new stock that is getting added. Okay, what's the difference between model portfolio and India 47? Kaushik, model portfolio is a list of hand-picked stocks that are picked by the research team. Handpicked by the research team. These stocks meet the CanSlim criteria, as I had said before. And whereas India 47 is an algorithmic generated list of top quality stocks that meet a certain fundamental and technical criteria that we have set. So it is based on an algorithm. It is updated on a weekly basis. So as an investor, as a user of our app, what you can do is you can use our model portfolio if you are a stock market beginner, and once you gain a knowledge about gain a good knowledge about the CanSlim investment methodology. You can also start looking at the India 47 list. Not all of the stocks are actionable. You need to look at stocks near buy point. So in the India 47, there is an option to look at stocks which are near the buy point, and then maybe you can evaluate on the basis of CanSlim and see if you would like to invest in that stock or not. Right. So Raj is asking what's the minimum beta value we need along with relative strength during downtime. See, Raj, again, it's a gray area for an investor who is risk seeking. For him, a beta of 1.5 would be less, whereas for a risk averse investor, a beta of 1.5 would be too high. So I would say for a risk averse investor, a beta of around 1 is fine, and a relative strength, as we have in our CanSlim criteria, should be greater than 80. Right, how do you calculate the beta of our portfolio? So the definition is there on our website. We basically look at the stock's performance compared to the index over a 12-month period, and we see how the stock has moved in comparison to the index, and that's how we calculate the beta of. Okay, how do you calculate the, I'm sorry, I read it wrong. How do you calculate the beta of a portfolio? So there are different methods. You can use a weighted average method as well. So how much of your portfolio is going in a particular stock, and you can take a weighted average of the beta accordingly. Right, so Badri is asking if someone has 25-30 stocks, when is the best time to come out? So Badri, this and form a model portfolio. So Badri, as I had said before, when markets go down and when they enter, say, uptrend under pressure and or downtrend, there will be a lot of stocks that that will break down their below their 50-day moving average, that will show signs of weakness, that will see high volume selling, and it's a good time to kind of book profits or cut losses in such stocks, and then slowly and steadily build a new portfolio. Okay, Mitesh is asking where can we find which industry is doing good. So Mitesh, what you can do is you can use the filter India stocks feature, and once you have filtered stocks on the basis of a few criteria, so you can put EPS rank as high and price strength as high and all those things. Once you have done that, you can sort all those stocks on the basis of industry group ranking, and that will give you an idea of which industry is doing good. Right, so Balaguru is asking where can we see beta alpha value in apps. So I'll quickly try to show that. Please give me a moment. Right, so the 3M India chart is open over here, and once you go to the chart, all you need to do is there's a small arrow that can be clicked over here, and you'll find the beta over here as well as alpha. Right, Sanmesh, I would request you to send stock-specific queries on MarketSmith using the Ask MarketSmith feature. That will allow us to, focus on the current webinar and questions related to the current webinar. Right. So next query that's coming in is, what is alpha? So alpha, it gives you an idea about how a stock moves with respect to the market. If it has a positive alpha, it shows outperformance. If it is negative, it shows underperformance. Okay, Kaushik is asking about P ratio. So Kaushik, P is a very P is P ratio has a lot of misconception in the market. Investors, they tend to focus a lot on low PE stocks and ignore high PE stocks. But one thing we need to understand from the history of the Indian stock market or any other stock market, be it US or any other developed market as well, what we have seen is high PE stocks tend to do well. Low PE stocks might look attractive, but if they are not showing high sales and earnings growth, there's no point investing in them. Whereas high PE stocks, they are selling at a premium for some reason, and the market is ready to give that premium to it because the overall perception about the stock is pretty optimistic. So Gaurav is asking what's the difference between beta and alpha. So beta will give you an indication as to how much a stock moves. So it could be both either on the upside or downside. Whereas alpha, if it is positive, it shows that the stock is outperforming. Okay, guys, we are running out of time now. And if in case I missed any of your queries, I would request you to send it to the Ask MarketSmith using the Ask MarketSmith feature. And I'm right. So yeah, the recording of this webinar will be uploaded on our blog as well as our YouTube channel. And thank you very much, guys, for your time. Appreciate you took out time and joined us in today's webinar. And we'll be coming with a next webinar in a few days' time, and you'll be notified about that as well. Right, so with that, we'll have to close today's webinar, and our next webinar is scheduled on March 6, 2018. We'll look forward to interacting with you all in our next webinar. Thank you very much for your time. Thank you, guys.